Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Thank you for joining my podcast today, this Friday. A lot to talk about. We had a big short covering rally. So let's start out with, I had a lot of questions about how come gold? Why isn't gold rallying? Why isn't it participating? I mean, it went up a little bit, but not like what we're seeing in the other stock sectors like tech. Well, let me explain. Again, I always tell my members that, look, you got to follow the yields because the yields tell you everything. They tell you where the direction of the market. The yields is a roadmap. And also the dollar follows the yields. So it's so helpful when you follow the yields. And like today, all of a sudden the yields started to pull back, which made sense because, again, that's when everybody started to go in and buy in a dip and, start to rotate. So to answer the question about gold, gold is very much tied to the yields. If you have, right now the yields are above 4.20. That's not good for gold, the gold stocks, metal stocks. It's not good. But if you can get gold near 4% to 4.10, at least gold's not going to go down anymore. It starts stabilizing. But to ask, the big question, well, when does it start to rally? When you get below 4%, when you get to about 3.8, 3.9, then you're going to see the gold stocks come back. So that's what you have to look at, okay? And again, the yields are so important because it's the truth serum, it's the map, it's everything. Okay, so let's start going over what happened here this week. But first, I want to talk a little bit about. We all know that the big problem for the midterm elections, right, is everybody's afraid of, hey, things are too expensive. They're still too expensive. What are they going to do? So the midterm elections, everybody, it's like a toothache. You forget about it. Everybody forgot about the border. Millions of people coming over. They forget who got killed by the people who came over the border and raped and murdered. They don't want to hear that anymore. That's yesterday. They want to know, what are you going to do about cost and getting the economy, things down so we can start this economy back up. But one of the biggest things that nobody's thinking about that's going to hurt the stock market, the economy, and everybody else is the fabrication that there was not going to be any more, taxes on seniors and Social Security. That was over with. And none of that was true, of course. It wasn't true, and I'll go over that with you. And remember what Trump said? Play the cut.
No tax on Social Security for our great seniors. Our seniors, no tax.
Oh, that's just not true. If it was true, then Congress would have went in and they would have revised the, I think it's the 1983 tax law. They didn't revise it. You can't say, okay, there's not going to be taxes on Social Security unless you revise that tax law. They never did that. But what did they do? They went in and they took and gave us an $18,000. They dropped the discount that we have. Not the word's not discount, but they dropped it by $18,000. Okay, and what happened once they dropped that? God, I can't think of the word. It's not discount. It's I'll think of it. But once they dropped the this, was it repo? No, it wasn't repo. I'll come up with it, but it's something like a dividend or something in that sort. But they dropped it by 18,000. That's where the problem came in. That's where everything changed. And that's when the deductions. I'm sorry, deduction just finally hit me. Deduction. They dropped the deduction by 18,000. That was a terrible thing to do, because what that did, it made everyone who was promised, the seniors, the couple's combined income, that they would no longer have to pay taxes on their combined income, anything above, 64,000. That screwed them. They're going to have to pay more now. That's right. By lowering that by $18,000, that deduction. That's how Congress screwed every senior that makes above 68,000. So their taxes are going to be far higher on Social Security now than they were before. That's going to really hurt, I think, in midterm. That wasn't a good thing to do. But now, the people who make up to and 68,000, they never pay taxes. They never pay taxes because that's the law. You don't have to pay tax up to 68,000. So what happened to them? Nothing. So nothing happened to those who make a combination of 68,000. They paid no taxes 10 years ago, last year, and they're going to pay taxes this year or going forward. Once you get above that threshold, you're going to pay a lot more taxes than you were. So this is going to anger a lot of people, and that's not going to help the economy. See, everybody thought, well, if they cut the Social Security tax, people have more money in their pocket. And that was the whole idea, but it was not true at all. So, and you can look it up and see it's just not. So going back to what happened this week, this was a big short covering rally we're seeing. And this whole thing started to collapse around AI again. The jibber jabbers on TV and Wall Street came out the other day and said, and they're doing this to pump up the AI stocks to get them to rally. They said, oh my God, look at the money they're going to put into CapEx money spending. They're going to put $180 trillion into spending. And the institution investors said, what? We're not getting any returns now. We're barely getting a return. So and that's on the proposal of 60 to 80 trillion. You're going to go to 180 trillion, and we're not getting returns. That was fake. That was all fake. They painted the tape with that because they thought by saying that this money was going to go in that it would encourage investors to jump in and start buying. Oh, AI is back, it's strong. Did just the opposite. The big institutions started to bail. But they rotated, though, out of tech, especially AI, and they rotated into where all my members were. First of all, in banks, okay? The small banks, not the big banks. And watch today as the market's going up. This is all short covering and all buying on the dip. And the FOMOs, you have the dips, you have the FOMOs, short covering. Very little of this rally is new money coming in. So don't chase these. Don't chase these. So, or you're going to, and you don't want to chase them because when you get a big rally like this, you want that particular stock to pull back about a quarter of the rally. So you get a big short covering rally, you want to pull back at, a quarter or less, and then let it rally again and test the top. Remember, all tests are at the top. So when you get a big spike, you sell into that spike. You don't have to get out of it all, but take your profits, put in your pocket, let it come back again about a quarter or less, a little less, and let's see if they can run it the second time and break out. Now, if they can't break out the second time and it pulls back, it's that third time that's critical. If they can't break out there, then you got a problem. Then the market's going to sell off again. Also remember what happened, and I'm going to go to my chart. You can follow me. So if you look at the chart, we also had, if you remember, the trackers, GLD, XLK, and the dollar UUP, they are trend trackers. They tell you if the trend is breaking. Now, if you remember, the trend trackers said that when we had this sell-off, this was only because of the big profits the institutions took out of silver and gold, because silver was up 60% in 4 days, and 4 weeks, and gold was up big time too, 25%, so that's extraordinary. So they went in and they bought took all their profits, and that's why we had that profit taking is what took this market down. That's what happened. Now, so the trend trackers point out that if you looked at a stock, when you know a trend is breaking, let me put up CRM. When a trend's breaking, this is what it looks like on your chart right there, your stochastics. Once it gets through that 80% right there, it's not going to go back up, okay? Now, at the time when this happened, let's take a look at GLD. GLD was nowhere near, okay, that area that CRM hit right here, just underneath that 80%. Don't have to go all the way down, just under that 80%. Now, if you look at tech, XLK, it's still, when you look at it, it doesn't look like CRM at all. But tech is the worst one, and she is rolling over, but you don't have that confirmation like you do with CRM. The dollar, also, there's no confirmation, because when the dollar was coming down, the trend was correct. It was going down. When the dollar snapped back, the trend should have turned and went back up, but instead the trend is solid down. So the key in watching the trackers is all three, GLD, XLK, and UUP have to break down all at the same time for it to confirm that you now have a key reversal. That hasn't happened. Now UUP doesn't go down. UUP, you want to go the opposite way. You want it to go up. But my point is, those are the things that have to happen. Now we all know the stocks do whatever they're supposed to do, but never when they're supposed to do it. So that's why you follow the money. You don't follow the noise. So that's what happened there. Now, if you go and take a look at what happened, it's all short covering that's going on. And look what happened this week to NVIDIA. And look at the short covering on NVIDIA today. See that short covering? That's huge. That's not new money. They're buying on the dip. It's in a downtrend, and that's called a snapback. So what you never want to buy that. Let it pull back and test the top again, because that's where the test is, at the top. So if you chase an NVIDIA today with a FOMO or with a tourist trader, you're going to get hurt. So again, because people don't realize this is the same people who sold short are just buying their position back. So this isn't new money. So we see this all the way through. So the only thing that's been doing well, or a couple that's been doing well, they're still continuing to do, is our small banks. The small banks are doing terrific. And if you look at all of our banks, we've been in all the small banks, PNC, Key, MTB, they just soared. They've been doing well. Our industrial's been doing well. Our Caterpillar, our FDX has been doing well. So that's where we are right now, and we're going to stay there until there's a confirmation that this sell-off we had this week is going to stay put, that it was a real reversal of trend, but we don't have that yet. It could change, because like I say, markets always do what they're supposed to do, but never when they're supposed to do it. That's why you follow the money, you don't follow the noise. So that's what I think, again, you should do at this point. And this AI, between the AI spending fears that took this market down, killed the big AI names, NVIDIA and Broadcom, PLTR, Oracle. At the same time, they've been lying not only about seniors no longer have to pay tax on Social Security, they've been lying how strong the labor market's been. That's not true at all. In fact, this week, the labor market's pretty, really, jobs are soft. So we got that. We got soft jobs. We got the CapEx fear. And so, again, right now, all that's happening is people jump back in, bought their short positions, so you just got to let this thing settle out for the next 4 or 5 trading days. Then we know the direction. But always follow the yields. and your spreads, and you know exactly where the market's going to go. So you can join us, the Phil's Gang. That'll help. Free for 10 days. Thank you for listening.